Okay, thank you everybody for coming here to join this panel discussion on a topic which people are not that interested, but China, not terribly important. We're having a little bit of a debate before this session whether there's a fatigue about China or are people excited, are people afraid? I think these are the topics we are going to unpack today. I'm very honored here to be on stage with esteemed panel here. Let me very quickly introduce all of them. On my far right, which is on your left, we have Mr. Yan Xuan, who is the president of Greater China for Nielsen. On my immediate right, this is Mr. Law Tech Singh, a partner and CIO for Hopu Investment, a private equity firm based in Beijing, headquartered in Beijing. And to my left, Mr. Shengming Gao, the chief economist for China Research for Citigroup. And to his left, Mr. Greg Donahue, CEO of Double Haven, a credit investment company. And finally, Frank Yao on the far left side of the stage, who is a senior portfolio manager, vice chairman Asia for Neuberger Berman. So we have a very sort of a balanced sort of panel here, from economists to real economy to three different type of investors. I myself run the Singapore office for Partners Group. We're a Swiss private equity firm. We run about $50 billion of assets, all in private markets on behalf of mostly institutional investors. So let me start by maybe talking about everybody here, I'm sure, is interested in what happened since August 11th, right, with the whole move of RMB, what has happened in terms of, some people call that a turmoil, some people use other words, of the Chinese equity market. And so what I'm interested in first of all is to hear from my panelists how they see this, the market movements, are they reflecting fundamentals? Are they more psychological, and the impact relationship between the Chinese market and the overseas markets? And so let me start with Xuan. Let's start from a more real economy angle. And Xuan?
Yeah, absolutely. The stock markets have been going through roller coaster rides. I think the key point about the stock markets are really the government should play their regulator role instead of being both the referee and the player. I think government intervention to some extent is necessary, but fundamentally the Chinese government should consider really playing its role as the market regulator instead of market player. I think the second point is, what we're seeing in China, whether it's the currency devaluation or the slowing GDP or the stock market performance, these are simply reflections of the new economic reality in China, which is called the new normal, which we will discuss in a bit of depth today on this session. And then thirdly, we need, as investors, as companies playing in the China market, look really through the rubbles and look beyond the stock markets, and then seek the future opportunities for growth. If you look at China, you look at the population, you look at the urbanization, you look at the income growth, you look at the emergence and the expansion of the middle class, well, can you find another country of the size and scale of China in the rest of the world? So I would argue that China was, is, and will continue to be one of the most attractive markets to invest in. And I echo very, very strongly what Mr. Mike Milken said yesterday, about this consumer-led, consumer-driven economy. So those are the 3 points I like to make.
Sure, and I'll come back to you about how do you see exactly what is this new normal, right? I mean, China is a big country, and when you run a big country, you almost have to run by slogans because that's simple, everybody understands it. And new normal certainly these days is one of the most frequently used word, and people interpret it in dramatically different way depending on how you look. I'll come back to you on that. I'll also come back to you later about the growth drivers, talk about consumers. So now we heard that. Let me move to Frank. Maybe Frank, can you also tell us a little bit from a public market investor angle, how did you see the market turmoil? did you worry about it? Do you still worry about it? Does it reflect the fundamentals in your view?
Sure. Well, first of all, thanks, Malcolm, for having me here, and also thanks, Bonnie, for good invitations. I think, as you probably know, for past 3 months, China market, probably also other emerging markets, both equity side and fixed income side, has experienced significant extreme volatilities. If you calculate implied vol for China A markets, we are talking about an implied vol between 50 to 75%. So it's extremely high volatilities for China markets. Now, a couple points I'd like to have, as Yan just mentioned, the government interventions. I think we have to divide this into 2 areas. One is something it's necessary for government to step in to stabilize markets, to minimize potential impact to entire financial systems. Thinking about it, on the end of the July 8, half of the China A markets stock suspended. Right? If PBOC, not jump into it, I think you're talking about China A markets in a couple weeks, it could potentially collapse. So we're talking about half of the stocks suspended on the July 8. We're talking about 45% of market cap suspended in their days. So I think it's the right thing for PBOC to jump into it to stabilize equity markets. That's exactly what the Fed did in 2008. That's exactly what Hong Kong, HKMA did during the financial crisis. I think this is the right thing to do it. Now, in terms of the other measures from government, we're talking about change of the margin financing. We change the low on the index future from T plus 0 to T plus 1. I think this is probably something open to discuss. Now, in terms of fundamentals, really during this short period of times, we don't see any dramatic changes on underlying fundamentals, particularly on the company levels. Now, as to renminbis, obviously, and timing-wise, is obviously very interesting. But I think PBOC did what they plan to do. I think if you look at the PBOC statement or comments from the Governor Cho, this has been the case for almost 2 years. That's what they want to do. Obviously, you also have a technical factors, SDR, and so on. But I think that's exactly what PBOC had telling the war. So I guess in terms of renminbi, I think we think it will be stabilized from now to by next 6 months. As to next year, I think it's something we have to see.
Very good. Thank you, Frank. I think the renminbi topic is something we'll come back as well. Obviously, it's not only about the Chinese equity market, right? The global markets reacted this time very strongly, immediately, directly in response to what's happening in China. Some people argue that's justified. Other people argue it's not. And the other worry, obviously, which has been for a much longer period of time than the response to the equity market, is about the debt situation in China, right? Do we have a sustainable level of debt by the municipal governments? Do we have that in private sector? So Greg, can you share with us a little bit how you see the whole debt situation in China?
Yeah, thanks very much. We've continued to keep our portfolio exposure in China pretty consistent through this period. What people don't understand is in the dollar space especially, the amount of debt to GDP in China is only about 6% in dollars. So it's really a domestic debt market. It's not really a foreign currency debt market. So it's not going to be subject to a lot of these global volatilities. At the same time, you're seeing the government engage in the domestic market in trying to clean up the shadow banking, or what I prefer to as the municipal debt space, with a quantitative easing program. So they've basically put out about $2 trillion to buy the municipal debt today that historically would price at around 8 to 10%, somewhere more near the interbank market, so 4 to 5%. That's improving transparency. It is increasing liquidity at the provincial level, but also then the issue is you're really just getting a corporate debt exposure in the region. So when you still look at China long term from a debt perspective, we're going to still continue to look at it. We're starting to see more and more corporate issuers that historically didn't issue internationally start to come to the market. Gives you diversity. You're seeing a lot of activity in the internet space and interbank funding, that the excess cash flow that goes there is deposited with a central bank. So from our perspective, just to keep it short, because we have a lot of people here, we're still long-term very bullish on seeing more credit in China. And to summarize, the dislocation going on onshore locally in the shadow banking, we see that as an opportunity to put more money to work.
Thank you, Greg. But in the short term, has the movements in the equity markets, was there any impact on you or your peers who look at the debt space?
Well, from a credit perspective, the equity, we care basically about their ability to pay coupon and principal over a longer term period of time. So when we analyze that, we're not as concerned about the quarterly movements. So yes, there's been this volatility, but the issue is more that the issuance external has mainly been state-owned. If you look at what's been happening, the big question everybody talks about is China real estate, high-yield issuance internationally. Because interest rates have been cut locally onshore, a lot of the high-yield companies have been able to fund themselves now onshore and buy their offshore debt. So what that has meant that the Kaisa event at the beginning of the year that caused concern in the high-yield market of the China high-yield real estate companies has been muted because these real estate companies have now funded themselves onshore. And then when they fund themselves onshore, they're actually going abroad and buying the dollar debt. At the same time as the currency depreciates, you see a lot of people move their money out of renminbi and move into dollar assets, and a lot of that money then goes to names they like and recognize. In the China case, it would be China companies in the real estate space that are paying a yield. They care only about buying that bond, holding it to maturity. They don't really care about the volatility.
Very good. Thank you, Greg. And I guess a similar question to you on the private market side, right? I assume you are you're less exposed to the short-term volatility like we do, because private equity, we take longer time horizon. Can you share with us a little bit how Hopu is looking at this?
Now, I think if you look at the Chinese private market, there are a lot of good assets out there. When the market comes down in this manner, there are many opportunities out there. But the investing in China today essentially is getting a fair price for what you want to buy. But then what constitutes a fair price, that will be another debate. But the investing landscape in private equity today, vis-a-vis a couple of years ago, is very different. All right, you got more competitors. You have national pension funds. You heard of Anbang. You heard of a couple of other names that's coming out, which are not available a couple of years ago. And now all these guys are actually better organized, have access to long-term capital, have an operating team on the ground. So investing in private equity today, vis-a-vis a couple of years ago, is very different. Number one, competition is up. Number two, the easy money is over. Number three, there are certain deals which you will need to have access to. Not all deals are available to everybody. So that is what the private equity market looks like in China now. And going forward, I think the competition will only increase.
And the correction in the public equity market actually creates opportunities for you guys, I assume?
Of course, yeah. And I think the correction for us, if you look at the private equity market, 12 months ago, last year, what is the index? 2004, 2005, 2006. So if you look over a longer term horizon, today it's about 3,000 plus, it's all right, it's okay. But when you are looking from a 5,004 perspective and looking it down to 3,000, it's a big drop. But if you look at over the last couple of years, it's actually increasing moderately. I think there's still a lot of opportunity out there, but again, it's how to pay a fair price for what you want to buy, and what constitutes a fair price, and what are you buying?
Yeah, and this correction give you higher chance to discover that fair price, whatever your definition is. Mingao, you are hearing this from the practitioners, right? The real economy, different type of assets class of U.S. manager. As an economist, how do you see the equity market, the recent moves?
It seems that our panelists here are more optimistic than the average of our investors. In my experience in the past 6 years when I moved to Hong Kong, this time, I think it's almost the most bearish time on China from the investor world. I think the concerns are two. Number one, the economy is still slowing down, right? So even by August, there is no sign of stabilization. There is no clear sign of stabilization. And secondly, on the policy side, the equity market intervention has caused a lot of concerns. Some clients thought China is reversing its market-oriented reforms, right? So they are very cautious. And then it comes the RMB depreciation, right? So RMB depreciation is comes at the very bad timing. It caused a lot of concerns, and many of our overseas investors believe this RMB depreciation is almost like the last resort for the Chinese government to stabilize the economy. To me, this is a misunderstanding, right? So I think the view on the Chinese economy largely affected by the policy in the near term. But the policy-making process in China is different. It's not that transparent. And when we all worried about the economy from the economic perspectives, the policymakers in China, they're looking at their political perspectives. For example, why August 11 to reform the FX regime? Economically, it's very bad timing, but politically, maybe it's the only time that they can do it to increase the chance for RMB to be included in SDR, yeah. Right? So President Xi Jinping is visiting the US next week, and the discussion will be done in November. So clearly there is a gap between economic-based views and also political-based view. So how that gap will be closed, I think that actually is something to watch. So our view is that in the short term, we are a bit more cautious on the economy and on the market, but in the longer term, we are more constructive, right? So in the short term, the actual growth rate in China, in our view, is not 7%, it may be 4 to 5%, right? And the difficulty is that if the government wants to stabilize the economy, they would have to rely on older economy, older China, which is oversupplied, over-leveraged, right? So we are in the transition from the old economy to the new economy. I think, to me, the easiest bit for the government is just to admit the slowdown in the economy. Don't overstimulate the economy, right? So let the adjustment go on for a few more years, maybe 2 years, maybe 3 years, right? Could be even a bit longer. So after that transition, the Chinese economy can move gradually from investment, exports to consumption, right? So clearly, if you look at China's export growth, year to date, 0% growth. But China is still gaining market shares in the export market. So this really suggests the external demand is much weak. And that could be the end of China's growth model, which is depending on exports, right? So the shift itself is painful. And it seems that the Chinese government is not ready for this kind of painful adjustment. I think that's where we are. And so whether we can get through that process, I think policy reaction is critical in coming months.
Thank you, Miguel. I think our panelists have touched upon a fairly wide range of issues. The way I see it is that I think the global markets over the last 5 or 6 or so reacted to what's happening in China in a sort of almost slightly confused way. At least they mixed up a number of different topics, right? There are certainly financial markets issues that are more short term, and people can argue the role of the Chinese equity market, is that on par with, for example, the US equity market in relation to the Americans' wealth accumulation, right? I think there's a strong argument that the Chinese equity market is much less relevant from a wealth accumulation angle compared to a typical developed country, right? So people react to that as if it's something different. And then there is more fundamental topics, which Mingao and a few others have touched upon, is Is Chinese economy continue going to grow? At what pace? Are there fundamental changes in the short term compared today to 6 months ago? Are those fundamental aspects dramatically different? I think you can have different views. My personal view is it is not. I don't think Chinese economy today is dramatically worse than 6 months ago. But people tend to sort of mix up the long term. And then you have the RMB topic. I think people can genuinely disagree. Is it really driven by the move to a market-driven system, which frankly everybody has been expecting the government to do at some point? It's a very positive thing, right? To eventually link the value of RMB to the international markets, no longer to peg it to the US dollar and sort of depreciate as they have done for the last number of years. But that then coincided with this decision to do a one-time sort of depreciation, right? So that gets mixed up as well. Then you obviously have other non-economic events such as what happened in Tianjin, right? So I think people are reading this a whole set of different topics which are very different in nature. Some of them are short-term, some are long-term. Some are positive, some are not positive, some can be interpreted differently. But when you look through a negative lens, all of them can be read as something bad, and therefore that triggers this very negative events. But for me, I think what matters more is what's going on at the fundamental side, right? Are the drivers still there? Is the economy going to land in some level that is sustainable, but still strong enough to both drive the China itself and the world? So with that, let me go to Xuan again. Can you tell us a little bit more, right? This new normal, China is landing somewhere. They coined it as new normal. What is new normal? What's new? What is normal?
For sure. Nielsen looks at the new normal from 4 dimensions, and I'll quickly talk about some of the opportunities and the implications. First, new normal is simply a reflection that the economy has slowed down, but we have to, just accept the reality that it's not going to grow double digits anymore or anytime soon. You have Dr. Shen putting GDP growth at 4 to 5%, and then you have the well-known economist Lin Yifu, who's the permanent bull on China, putting the GDP growth at 8% in the next 20 years. I don't know what the assumptions are, but we need to understand those. But fundamentally, if you look at the growth, even if China just grows at 5%, the incremental output would still be bigger than that of the GDP growth in 2014, growing at 14%. So, or 10 years ago, at growing at 14%. I think the second meaning is the second dimension is the diminished return on infrastructure investment. The examples are that China produced and consumed concrete. That's more than what the world put out and used in the past 30 years. Wow, that's pretty staggering number. And then everybody talked about, jokingly, how many construction cranes, 50% of the world's construction cranes were in China. So there's a limit to how much you can, invest in infrastructure. China announced another investment in 25 new airports last year. I don't know how many of them will end up being, empty. And then aging, we talked about hyper-aging yesterday. I think for China, it's the diminishing population dividend, and hopefully the new population policy will help a little bit. And then finally, consumer confidence based on what we're seeing, it used to be really high, and now it's coming down. So what are the opportunities for us going forward? What are the big trends that would work for us? Number one, domestic consumption. If you look at the U.S. Domestic consumption as a percentage of their GDP, it's about 70%. And for China, it's the reverse. So consumption as a percent of GDP is still very low. That speaks to the opportunity we have and the government has to really stimulate the growth of domestic consumption. And secondly, if you look at urbanization, so far about 700 million Chinese citizens live in towns and cities, and then the government wants to urbanize another 200 million. What does that mean? That means more middle class, more consumers. And second, and then thirdly, if you look at income growth, the income growth in China in the past 10 years has remained consistently at 8 to 10%, and there's no reason to doubt that's not going to continue, because the government wants to make sure that China doesn't fall into that trap. Of course, whether the companies can afford to pay that kind of increase, that's a whole different story. And then finally, the growth of e-commerce. A lot of people are saying that's a zero-sum game. It's not. 60% of the e-commerce growth comes from cannibalization of offline sales, but 40% really comes from new sales. And then you also have a lot of penetration into the lower tier cities and the country. So on balance, you still see this engine that can be can carry the country forward if you look at some of the bigger trends.
Let's go into a couple of the topics that Xuan just mentioned on the investment side. Mingao, the economist, do you worry about the empty airports, 25 of them, bridge to nowhere, this type of talk? Do you worry about that?
Well, it depends. I mean, we looked at the airport density in China. It's still much, much lower than many other countries, right? So, I mean, nowadays, Chinese people started to travel. So I think it depends how they locate those airports. I think that's the key. Right? Talking about, say, high-speed rail, in China, if you move between Shanghai and Beijing, it's very crowded, right? But of course, if you move farther to the west, there will be empty trains. So I think a location is still key. We looked at the capital stock per capita versus GDP per capita. China is actually well in line with the G20 trend. Okay, we are not like far higher than the global trend, right? So the issue, the problem is not about investment. It's about how to make those investments more efficient, right? That's the issue. And that needs reform, say SOE reform, like urbanization, right? So again, I mean, in my view, okay, the market now so far has factored in almost zero reform in China, right? So this is actually a pretty bearish moment. I mean, as long as there are something, they are able to do some reforms in next a year or two, the market sentiment will change.
So you would agree that investment could continue to be an important part of the growth strategy going forward?
So in the future, it's, I think, a more balanced growth between investment and consumption services, right? It's not like China's investment will be 0% growth. And another variable to look at is really urbanization rate, right? So I looked at Japan, South Korea, and many other countries. Before urbanization rate hit 75%, investment is still a meaningful driver of growth. Of course, it's not like a huge driver of double-digit growth, right? So China's urbanization rate, officially, it's 50%, but that includes migrant workers. If you consider household, a hukou-based urbanization rate, it's only 35%, right? So we are far off, the threshold of 70, 75%, urbanization rate inflection. So unless, again, I mean, we believe China is falling into middle-income trap, we will never get there, right? So that's another assumption you have to make to be bearish on China.
Right. So on the topic of investment, for those of you, I'm sure all of you travel to China. Right? If you go to Beijing, if you drive on the 5th or the 6th Green Road, you know how much more infrastructure China needs, or even more so if you go to a second, third tier city, you will see China is, in spite of all the portrait of China as this big economic power, a lot of the smaller Chinese cities still need roads to be built. They need bridges. They need a lot of things. So I would agree with Mingao. Actually, I actually think there is considerable headroom still there. And if you look at, Mingao mentioned the per capita capital stock in China. China today's level is United States in the 1930s, right? So I think there's considerable room for China to continue to in the Chinese word, you walk on two legs, right? I think one of the legs will continue to be on the investment side, and but they need to do it in a way that is slightly different from before, more selective, and probably more also considering the impact on the quality of life today to people, right? But let's switch to the consumption side. Why don't we, I want to ask three investors, right? Sort of you have heard about what we have talked about, the urbanization, the middle class. How much of those, in terms of if China continues to do investment, but China will do more on the consumption, that's for sure, right? Today, I think the consumption's contribution to GDP in the mid-30s or low 30s, depending on how you look at it. That's many years behind what a normal developed country. Korea, I think, is in the mid-50s. United States in the 70s sort of neighborhood. How much of those are in your mind in terms of the economic rebalancing towards consumption, middle class? Can I start with Frank first, quickly?
Yeah, I guess, if we take, it's quite interesting, when we talk about the new normal and so on, the main reason for China to have this new normal is to have a more sustainable economic growth. Whether it's a domestic consumption, whether the infrastructures, again, infrastructure is a part of investment, because investment also including, real estate and so on. But I don't think the residential real estate is the right place to put a lot of monies for China's, given the inventory levels, particularly in Tier 3, Tier 4 cities. Now, I think speaking for domestic consumptions, one thing probably is under appreciated by international investment communities. I think the first 6 months, China domestic consumption actually makes up over 50%, actually 60% of the GDPs. I have not seen much coverage on these numbers, but again, it will be interesting to see next couple years whether this percentage can be sustainable. So that's one. Secondly, I think on the more sustainable side, as China put a lot of efforts on quality of the GDP growth, I think some more areas it will be very interesting. One is environmentals, broad defined environmentals, water treatment, solid waste, and a lot of environmental projects, roll out, starting for last year's. And the infrastructure, as a panels discuss, I think if you go to the, if you visit the Shanghai, Beijing, I think in terms of infrastructure, not just the airport, a highway, and also subway, is pretty much world class. I spent about 14 years in New York City. If you compare the subway system in Shanghai to the New York, it's I think it's quite different.
I think the question here is that I agree with you. I think it's world class. The question is more for 1.4 billion people, do we need more this type of world class infrastructure? Do we need substantially more? Therefore, that will infrastructure investment, for example, may or may not continue to be a big driver of it.
Yeah, I think there are some misperception, in China and also outside China, think the investment is the better things, right? But I think, as Mingao just pointed out, the key here is whether investment, particularly infrastructure investment, can produce, decent returns for entire countries. So if you go to the Western and Central China, right? Yesterday, I think some panelists talk about Africa's, but you know what? If you go to the Xi'an, right? Take the cost, right? 100 miles out of the Xi'ans, what you see probably is very similar to Africa, in terms of infrastructures, in terms of housing, and so on, right? So I think for China, you probably have a lot of things to do, particularly Western Central China. So that's another key component for future, hopefully sustainable growth for China.
Yeah, friend, I would actually add on that, since you already mentioned about Africa, right? I think the other growth driver China has, in addition to the traditional infrastructure investments, hopefully done better, more selectively, and the consumption-based, middle-class-based sort of is actually to export that infrastructure and capacity overseas, right? So it's not only Xi'an looks like Africa, actually Africa, the real Africa, actually could benefit from that. This is what I believe is why this whole One Belt, One Road strategy is about, right? The idea is that China will, going forward, not only export goods as they did before, but they could also help those countries to build their infrastructure, which in turn obviously help China to have another demand created, right? So I certainly don't think this One Belt, One Road strategy is a philanthropy to more driven by development or poverty reduction. That might be a very good side effect, but it's fundamentally driven by the fact that even for the Chinese economy, it's good for Africa to want to build infrastructure.
It's commercial.
It is commercial.
The end of the day is a
to create jobs for the Chinese company, to create use for the capital from China. So I think that's more on the infrastructure investment side. And on the consumption side, Texting, how much of your investment decisions are these days driven by consumers, middle class?
Very much, okay. I share a couple of data points with everyone, the audience now. If you look at the GDP per capita in Shenzhen, it's 24,000 US, right, per capita. Average is about 8,000 for the rest of China. So there's a lot of room to grow. That means it's actually, China is a big enough market for many successes and many failures, right? So it's very difficult to generalize who will do well as a country, whether they will do well or not. But for us in investments, we look across all sectors and we have a huge emphasis on consumption. Now, when we look across all sectors, the challenges we have is actually every sector has a lot of policy overhang, which make fundamental analysis very difficult because one fundamental change in policies can swing your investment thesis the other way around. But if you take a longer term view, over 3 years, typically our experiences tells us that your investment thesis will pan out. What you want to do even will happen. Now for consumption, what is interesting to us, for consumption investment, we do not pay so much attention to what is the GDP growth, but we pay a lot of attention to consumption index in China. We have, in our portfolio company, we have invested in a modern logistics company, and the warehouse space is still, the occupancy rate is still very high. They are still increasing very good rental increase in all the key cities. In terms of cap rate, there are still cap rate compression. So the long and short, if I look at what I have invested vis-a-vis the GDP growth, there seems to be a little bit disconnect. In short, the consumption story in China is still very strong. All right. Now, what is important to us, interesting to us, is when I look at what this portfolio company of ours, which particular kind of goods is actually increasing. Is it because due to e-commerce or whatsoever? I think there are two observations that stands out. One observation is that, essentially, initially our assumption was that e-commerce will continue to grow at a faster rate than the rest of the other sectors. But over the last couple of 6 months, 12 months or so, actually, our projection is not accurate. What surprises us is that when it comes to food, demand for food, safe quality food, the consumption actually went up, and the demand for warehouse space, number one. Number two, the demand for medical equipment, storage space for medical equipment, stuff related to healthcare, stuff related to pharmaceutical products actually went up. And this is a modern logistic warehouse which we invested. Now, again, back to consumption, when we talk about consumption number, let's also pay attention to organized retailing in China is still very low. If you compare that with Japan and other developed markets, organized retailing is very low. Right? So if you assume that the retail sector will continue to increase and the organized retailing will continue to take a bigger proportion over time, so that is actually a major driver for consumption.
Great, yeah. Thank you. And for you guys obviously run a lot of international investors, Capital, a US dollar fund, and Greg as well. Greg, let me turn to you for a slightly different topic on which is in investors' mind, if you're an overseas investor, right, which is RMB, right? Now, I think in the last 5 to 10 years, I would argue we had a fairly predictable sort of situation, right? Zhou Xiaochuan, Governor Zhou mentioned it 10 years ago, that the intention is to gradually appreciate it, and very few people really took his words at that point, but that's exactly what PBOC did. But now we're in a new territory, right? Now it looks like it is now at least theoretically linked to the market, even though PBOC could still intervene as they have done. How do you see that for you, from a credit space, Does the RMB affect your decisions? Does it affect capital flows in some way, both
Yeah.
in and out?
Well, that's a loaded question because there's a lot of issues interrelated in that. But I think China as a country has gotten a lot of FDI that's helped it continue to grow. And we touched on the middle class growth of the consumer space and creating a lot of opportunity going forward. And I agree with my colleagues on the panel that continues. As far as the real overlying issue is China is now going to open up their currency through SDR through the IMF, which is likely to occur towards the end of this year. As that occurs, what's going to happen from an investor perspective in China is really the question we need to ask. And a lot of people talk about China being included in the equity indexes as the real big bang. But really what I anticipate that's going to include is reform in the way that the banks and the pensions and everybody lend and invest in credit. Because historically, most of those institutions don't have a credit culture because they didn't need to. They just lent to the provincial or the local government. And we could talk about whether there's corruption in that lending or not, but there is a change going on that's part of the corruption reform going on that's going to create a different type of opportunity in lending and in credit domestically in China. And so what we call shadow bank or provincial banking, all this middle class growth of wealth or the Asian population of pension, the long duration capital is going to create a true domestic bond market. But more specifically, when we finish the SDI, I anticipate it, and then QDI 2, I anticipate more money will go abroad from China. And you're seeing it already as they go global. But what I think a lot of people don't understand, when these insurance companies, other people buy assets a million miles away, they don't move money. What they do is they deposit renminbi at a local bank in China, and then the foreign bank or the local bank then lends that money abroad. So there really isn't a cash movement. So we're anticipating that cash movement to have a bigger effect. Now, China is a big bond market. We could talk about it in the emerging market index. Yes, it's a big component. But as far as the big Barclays aggregate index that's 42 trillion, even if China were admitted to that, it would be only about 6%. So it's not going to, if you look around the room here, people talk about emerging market portfolios, but a lot of people don't allocate to emerging markets in general. And if they are doing it, it's been more in PE or other aspects that are more alternative. So the opportunity from an investment perspective, I think, is very good. Once SDR goes through, I think there's going to be a lot of changes in the credit space and a lot of opportunities there. Sorry.
Greg, thank you. I have many other questions. I want to pick this guy's brain, but I want to make sure we also have a dialogue with the audience here. Anyone has any questions? Just raise your hand, tell us your name and affiliation, and then ask a question or comment, something you agree or disagree. Okay, can we have a mic for the lady there? Okay, thank you.
Thank you. Thank you very much for your panel discussion so far. I'm Lucy Colback with the Financial Times. I have a question for Ming Gao. He mentioned that a lot of the participants here have been very bullish on China, and that's also been my observation, despite what's been going on in the markets. And I wondered if, given your position, you have an understanding of who's been driving the sort of panic in the market. Do you feel that people who haven't understood China have got overly involved because they thought it was a one-way bet? Or do you think that some of the older China hands are actually disappointed, giving up, lost the faith? I'd be very interested in your thoughts on that.
Okay, can I take another question and then we ask, just to be fair? Okay, the lady in the front, in the blue dress.
Thank you, Liana from UBS, and thank you very much for all the insights. Greg, just follow your question, your statement just now that the credit market is going to change dramatically and provide opportunity. What do you believe? What do you want to see as an investor of what government does? And on the other hand, what do you believe they will do? What do you think they will do?
Well, that's the old adage of China. We talked about it earlier that it's a controlled government, and it's very, and we've seen it really in the interbank market since 2011 till now, we've seen the rates go like this several times for the last several years. It's going to continue to be volatile from a China perspective. And I don't think they know what an open economy entails, but they want to head towards that direction. That's really what we're going to continue to see. So if anybody's sitting here going, I thought the renminbi was going to appreciate, they weren't really following what was going on in China. I think it'll continue to be more volatile. And I think the renminbi does have likelihood to continue to depreciate. But from an investor point of view, there's still a lot of opportunities in China to take advantage of. And the historical lending at X, because it's a province or a government, will change. That dynamic will change, which allows a true credit picture to put money to work.
Great, thank you, Greg. Minggao, for the first question.
I think distance matters, right? So if you live farther away from China, oftentimes you are more bearish on China. So in that sense, I think our clients in US, Europe, they are more cautious. Singapore here, it's slightly better. Hong Kong also marginally better than maybe here. I think the cause of this concern is really started from the equity market intervention, right? So clearly, everybody believed that the Chinese government tried to defend the equity market too early, or they tried to intervene in the equity market too late when margin financing surged, right? They should have done that in the beginning, but they did that too late and then tried to defend the equity market too early. And there's a reason that the Chinese government did that, because they said we want to avoid systemic risk, right? So, and the market's concern is that when you try to avoid the systemic risk, the government is actually accumulating more risks to the future, right? So as a result, in China, I think to me, my top concern is that whether the government will let the market function, right? So before August 11, the exchange rate is a straight line, right? GDP growth rate is 7 like forever, and equity market cannot correct. So eventually, basically all markets are stopped functioning, right? So I think the policymakers in China need to find a way to work together with the market and try to get some of the risks absorbed by the market. So in other words, the Chinese government needs to tolerate more volatility in almost every market. That's the thing, right? And I think a lesson has been learned, right? So they try to defend the equity market. Eventually, they gave up. And so now there's some concerns about the FX market. They try to defend the RMB at the current level, whether they can do it, right? So I would say, more market-friendly policy reform is a must to restore the market confidence.
Yep, very good. Let's see whether there are additional questions from the floor.
Thank you. My name's Andrew White from a family office called Sandair. I have just a question about, Minggao referenced a number of migrants in cities, and as always with China, the numbers are extraordinary. I think the last I read, there's something like 270 million migrant workers in cities who don't have the household registration, etc. My understanding is these people have a higher saving rate and are not buying houses, etc. So from a consumption point of view, it strikes me as a pretty easy win from the government to change these rules. How likely is that? And could you just comment on that, please?
Okay.
Yes, China has 270 million migrant workers working in the cities, and their savings rate is 50%, right? So it's, the Hefei government, which is from the central part of China, they have done estimation. If to urbanize one people, those migrant workers, it costs 150,000 RMB, mostly investment. Half of that goes on to social housing, 1/3 of that goes on to urban infrastructure, right? So you just time 150,000 with 200 million or 150 million. So this is a bigger number. This is actually the driver of the domestic consumption services, right? So the government has had laid out a new urbanization plan March last year. And in February this year, they started the new urbanization pilot. So far nothing happened. I think the key concerns, there are two key concerns. Number one, who pay the cost, right? Local governments, physically, their revenue growth is actually now low single digit. It's in a very difficult situation. So we needed to innovate a way to fund the urbanization. To me, I think this is a huge investment opportunity, right? And secondly, which is also very critical, is the land policy. So in China, land, the countryside is collectively owned. So how can we find a way to allow farmers to monetize land so that they can fund their migration, right? So these are the two potentials that can open up. But reforms are very difficult. So hopefully, I think China's reform is also crisis-driven, or it will be forced. So if the economy continues to slow, if domestic external demand cannot recover, I think China will have to look into itself to find a way to grow the economy.
I think governments around the world, every government these days are looking for that structural reform, right? Everybody knows that the current sort of economic growth essentially relying on the monetary policy is not sustainable. I would argue, if you look at China, I think a lot are happening, right? The government are really trying to see what structural changes they should make in order, in the long term, to create the room for further growth. On this discussion about investment and consumption, there's also something in the middle, which is related to urbanization. What I would call it as like quality of life investment. So it's investment, it's going to create growth in the future, but in the short term, for example, public housing, right? You have those migrants in the cities, obviously currently living in a very sort of sub-bar situation. And if government invests a lot in this housing, it both creates growth jobs in the future, creates jobs today, and it actually improves people's lives. It's almost sitting in between investment and consumption. And you also have what I mentioned, the overseas situation, right? Which brings me to maybe one last question to the panel. We don't have too much time. I think most of you probably were here last night and listened to AIIB, the president, Mr. Jin, and AIIB is obviously one of the cornerstones of this new push from China to export capacity, the way how I see it, and create demand overseas. But in the same time, there are positive side effects to those countries. I was actually in the room 2 years ago, almost exactly 2 years ago in Bali, at the APEC meeting when President Xi Jinping announced that. It was a big surprise, right? That's the first time people heard about what is that AIIB. It's a very strange name. One Belt, One Road, which also very strange sounding to the Western audience. Can I maybe quickly ask my panel, how do you see that, the One Belt, One Road, including AIIB, including the New Development Bank, they also known as the BRICS Bank, which is also China-led effort. Xuan, quickly, 1 minute.
Yeah, sure. Since we focus on the consumers, I'll just say invest in China for the China market, but also don't forget invest outside China with the Chinese consumer in mind. 3 examples: Lenovo's purchase of the IBM, PC business. That was an international play, but it made Lenovo China's business the most profitable one. Geely's acquisition of Volvo, that was an international play, but the Chinese consumers are getting the benefit of that. And then Shuanghui, a lot of people probably are not familiar with the brand. It's China's largest processed meat manufacturer. They acquired Smithfield of the United States, and it then instantly propelled them to the world's largest poultry company with $10 billion in sales. But their strategy is really focusing on the domestic Chinese market as a premium brand.
And taxing, cross-border deals, international
I think
deals?
China is in a phase where they are increasing their efficiency, moving up the value chain. So they are looking for staff, technology, machinery, in every form and format to increase their efficiency and and increase productivity. So for us, the opportunity lies in looking for products, procedure, platform. Nothing, you don't have to look for anything new, but something that's tested, something that's matured, but has a good application in China. And so in fact, your One Belt, One Road is actually a two-way highway. It's not a one-way highway.
It's about connectivity.
About connectivity. So what is interesting for us is that, this will be something that we're looking for, things that we can apply to China, something matured. We are not investing into a new business model, but we're investing into a business model that's tested, yeah.
Mingao, 30 seconds on the cross-border.
So I think two messages from the One Belt, One Road strategy. Number one, China is still willing to connect itself to the rest of the world, right? When China opens up, it's oftentimes that we are in a period of reform, right? So in that sense, I'm actually constructive about the reform outlook. Number two, the One Belt, One Road is try to export in redundant capacity, but we should focus on the key instrument of that strategy is actually internationalized, a more stronger currency. So over the longer term, in order to implement the One Belt, One Road strategy, the RMB will stay relatively strong rather than we are entering into a cycle of depreciation.
Any comments from Greg or Frank?
I don't think we have enough time, but
Yeah, just very quickly. I think when we talk about a One Road, One Belt, more focus on cross-border, export over capacity in China's. But I think keep in mind, if you look at the One Road, One Belt, right, the policies, most actually cross the central China and the West China's. So I think this also is for domestic interests for China over long strategically.
Yeah, from my side, let me make two quick comments. We'll conclude this panel. We're 2 minutes over time, but we started 3 minutes late, so I have 1 more minute to say. I was in Dalian last week and I had this interesting conversation with my friend, Mr. Sheikhan Bilek, who is now the new Prime Minister of Mongolia. He was debating about what exactly One Belt, One Road means. Is Mongolia part of the belt or the road or certain other countries? And so I told him, look, I think, which I want to share with you, right? The way I see One Belt, One Road is very simple. It's about this world of connectivity, right? It's not about exactly which country is on which belt and which road. It's about it's a signal that China is telling the world that connectivity can be a big growth driver for China and to all of you. And it was done before. So this is not something new, right? In the past, there was Silk Road, which worked very well. So today, how that road will go through is not important than the point that connectivity can be a growth driver. And my last point would be, I think we talk about investing in China, which is very important. My firm continue to look at China as a destination, but I think a much bigger story for investors is actually investing with China in mind, right? Maybe your capital is not going into China, but there is an angle to unlock that value in addition to putting your capital inside China. So with that, let me thank my panelists for your intervention, and thank you for your questions and your attention.